So super happy to see everybody, and I'm just going to kind of kick things off and talk about the reason why I'm doing this. Like I'd mentioned on kind of Facebook, is we've been, blessed to be, have been transacting a lot of various real estate over the years, and more friends and family have always kind of reached out and said, "Hey, how do I start my journey, or what do I do?" And so the goal was really just let's kind of share our journey and just see what see if that's valuable for you guys. So I did this specifically for friends and family. So obviously Facebook, and many of you guys I haven't even seen in years. So I'm so excited to see the names popping up. I'm going to do a better job myself of keeping up with you guys over the years. That's one of my missions in life, is just, get back in touch with everybody. So on that note, I'm just going to do a quick 30-second life catch up for you guys. So me, my wife, and my son, Rashna and Rian, have been living kind of still in Houston, right by the Galleria for the past, we've been married for 9 years. I moved back to almost a little over a decade ago. We lived in New York, and that's where I met Rashna. We've been living in the Galleria for quite some time. We just built our new house last year and moved in. I've been in the mortgage industry for 20 years, and hence the gray hairs and all that stuff. And I got the full dad bod and everything going on. But in general, it's been a long journey in the mortgage industry, which has been, the main aspect of how I got exposed to real estate. I kind of heavy duty started investing in various real estate assets in 2011. And so I'm going to kind of walk through that journey as we go here today. We fully spun off our own business as a lending company in 2019, right before COVID hit. So obviously a funny, fun time to kind of get started. But thankfully, our experience over the decades helped us kind of just hit the ground running. We also launched a real estate team specifically, centered around real estate investing and that kind of stuff. And then my world is just friends, family, business, and real estate. That's what I do. So that's my 30-second life catch up. I hope I can catch up and reconnect with all of you guys and talk a little bit more about just kind of what's going on in your worlds. Again, this is kind of isolated to friends and family, so I'm so excited to share this journey with you. There's a lot of questions that came through from the people that filled out the form, and there's a wide kind of aspect of people's experience. So I'm gonna kind of dumb it down as best as I can. So I apologize for you guys, those of you guys that are more advanced, but I'm just kind of talking through the basics, right? And then the goal is what we're going to do is we have a series of these that we'll start doing every month, and I'm going to bring in different kind of who I would, perceive or consider successful real estate investors in various asset classes. And I'm going to bring them in and talk about their journeys and kind of where did they start and how did they land where they're at in all the different kind of classes. So all the way from like just single family to the Airbnb guys to the, the multifamily, et cetera, et cetera. So on that note, I just kind of wanted to talk about like the 10,000 foot view of investment strategies, right? So these are the most common. There's many more. There's, quite a few, but I just wanted to kind of talk about like the top of mind things that most people kind of think about. So there's, HGTV, fix and flip, just buy something distressed, flip it for a profit. Nowadays, you're hearing a lot more about what's called a BRRRR strategy, which is effectively taking that fix and flip, but instead of selling it, you rent it out and then refinance it and retain it. And I'll talk a lot about that as a strategy as we go here today. The standard kind of off-the-shelf long-term rental, buy a house, rent it out, or buy a property and rent it out and just ride it into the sunset into retirement. So that's very common as well. Short-term rentals are super hot. Everybody's talking about Airbnbs and kind of coming in that type of game plan. So you'll see a lot of that. I've got quite a few friends that are doing that very successfully. So I'm excited to kind of talk about our exposure to that journey as well. People also just kind of buy to appreciate, right? So like sometimes cash flow is not necessarily the objective. It's like, hey, I know, Austin's a great market, for example, of like, hey, I just know this thing's going to continue to grow in value, right? And so sometimes that's a strategy. I'm not here to make your, strategies for you. I think everybody just needs to kind of get educated and decide what is best suited for them. But I'm going to talk about all the stuff. Thankfully, we've done a lot and we've seen kind of a lot of, various different strategies along the way. And so I'll talk about our experience, and that's kind of the goal today. There's tax reduction, right? So, there's huge tax advantages to owning real estate. So a lot of people, are looking to subsidize or kind of add a tax benefit to their income streams or whatever the case may be. And real estate is a huge vehicle, or, a fantastic vehicle to do that. Syndications, for those of you guys that may not be familiar, that's when kind of a group of people with usually a lead sponsor or general partner, they're called GPs, that will kind of lead with a bigger investment. Like it'll be like a massive apartment complex that's maybe like $10 million, right? So obviously for an individual, that's, you know, pretty challenging to take down. What'll happen is a group of people, typically with one lead person kind of, you know, putting the deal together, and then people jump in as what's called limited partners. And that's, you know, and they focus on buying one asset. So that's what a syndication is. And then there's full-fledged real estate funds, right? So that's where, you know, you'll park a subset of money or like a chunk of money with like a big fund, and then they have a strategy for buying, you know, whatever asset type that they're looking for. And so that is really, you know, kind of like the next level of kind of real estate investing. And any, like I said, all of these are ways to get exposed to it, right? So the individual stuff is typically your fix and flip or, you know, rentals. And then like once you kind of level up and you, some of you guys may desire to kind of get to that level, right, and grow. And so I'm going to just talk a little bit about these things as we go, but I just want to kind of lay the groundwork of some of the more common strategies. So one thing that you know, people always ask about is like passive versus active. You know, for us, we're kind of pretty active because we're heavily involved in the real estate that we acquire. But I'll talk about kind of the strategy. So passive, like I mentioned, you can just kind of write a check and invest with you know, a syndicator or a fund, and you're just kind of, you know, watching the action, right? We are LPs, myself personally LPs in a couple different type of deals. One specifically is a self-storage facility that where it was a guy that was building it from brand new construction, and he had a successful track record. So I wanted to learn more about that asset class. So we just made an investment, and we just got to watch on the sidelines and learned a lot about the asset class. So that was, you know, has been a good investment for us, but it was a good way for us to kind of just watch without having to lift a finger, really. You can also be a silent partner in joint ventures. I'll talk a little bit about that. I've participated in a couple of joint ventures, and I'm going to show you guys a little bit about the ones that I've done. And so we can talk, you know, you can certainly do that. And it's kind of the same thing. You're really just writing a check and just, you know, probably a little bit more involved as a joint venture. Either you're like, you know, sometimes it's like, hey, I found a deal, but I don't have the capital to take it down. Let me kind of find the capital partners that are stronger, and I'll do a joint venture with them. So a lot of you guys have probably seen like the online crowd funds. Those are also ways to just kind of passively get into deals. I personally don't do those, and I'll talk about why. Again, I'm not here to influence anybody's kind of thought process on what they should or shouldn't do. I just wanted to kind of talk about all the differences out there. The reason why I personally don't like them, though, is there's a lot of fees along the way, because they're just kind of online platforms, and you can kind of hop in and out of these investments. And, you know, I just don't think it's the best suited for me as a strategy. And then the absolute most passive is if you just want to like just get in and out and have liquidity, then REITs, which is real estate investment trusts. These are stocks that you can literally just buy, right? And then just be exposed to real estate, but not have to really actively participate in any way. Semi-passive, in my opinion, is like when you have third-party management or on-site management, if it's a bigger asset, but it's still rentals, right? So you're not actively worried about the day-to-day. That's how I started my rental property journey, is I immediately hired a property manager to take over the management aspect, because I really didn't want to be a part of that or participate in that, and I'll tell you why. But that's what semi-passive is. You're still involved, there's still decision making, you know, there's a little bit more hands-on, but you're, you know, for the most part, not really having to worry about the day-to-day grind. And then active is self-management real estate assets, right? So whether you want to be the, you know, the handyman that shows up, and I have a few friends that have bought rental properties and they like it. I mean, more power to them, not my cup of tea, but in general, that's very active, right? I believe that Airbnbs, when they're not third-party managed, are very active. It's like running a hotel, right? So I think it's a very active, you know, investment. And so keep that in mind for those of you guys that are looking at Airbnbs. And then real estate that has business operations. So for example, like self-storage facilities or mobile home parks or RV parks, there are a lot more activity coming and going. And so you're a lot more involved because there's actually a business that runs on top of the real estate. So you know, we've got exposure to quite a few of these, so I'm going to talk a little bit more about that, but I just wanted to kind of talk a little bit and help everybody kind of get a frame of reference of kind of the different management structures. So I'm going to take a quick drink. Sorry, I'm talking a lot. So my first strategies was I had no fucking plan. Like I just literally just started buying things, right? And so that's one of the first questions that I feel like everybody always asks is like, where do I start? Analysis paralysis. I, have learned, and I always learn personally just by like diving into stuff, and I learn as I kind of get in there. And so that was my approach. And so the positive was that I ended up being exposed to a lot of different asset classes and have kind of dabbled in a little bit of everything. However, really had no destination and no plan. I've since kind of come up with a strategy and a direction that we've now are focused on, and I'll talk about that kind of at the tail end. But yeah, I mean, I just kind of dove in and took a lot of punches along the way. I like learning by the school of hard knocks. I just, I feel like that, to me, that's the best education, is just learn by doing. And so that's what I've done. So one of the questions that, most people always ask is, where do I start? Well, the lesson that I learned is to really start with an end goal. And so it took me probably a decade of real estate investing to really have a clear vision on what my end goal now is. And so I've kind of started to paint that picture and shifted all of our strategies. We've sold real estate and we've repositioned real estate to kind of hone in on that strategy. And I'll talk about what that is for me personally and my family's goals in terms of our real estate investing. But everybody kind of has a different goal, right? Like whether it's just kind of building a retirement strategy for yourselves and accumulating real estate that you pay down over, the course of 10, 20 years or whatever. And then, as you come out of retirement from your career, you now have a nice, healthy real estate portfolio that, pays for your retirement. Some people are like trying to, invest their way out of a job and get out of their careers. And I respect that. And I think that's very doable depending on the strategies you take. But I think everybody needs to kind of have an end goal in mind. It could be just secondary income. It could be just building wealth. It could be getting into these syndications, building a fund, it could be any of those things. But I think a lot of people kind of dive in first, whether they see an attractive deal or just like, hey, I want to buy this rental property, and not really thought about like a strategy to get to the end goal. And so that's one of the first things that I'd recommend is like, think hard about it. I'm going to try to talk about some of the various properties that we did and kind of what we learned along the way. I'm definitely going to be sharing some war stories and whatnot along the way. So just kind of keep that in mind. But, I had no plan. I had no strategy for the past 10 years. And so we had just kind of like took a bunch of punches and learned along the way. And then long story short, we landed on kind of a direction. So let me click this, sorry. So I'm going to talk about my single families, right? So I started buying single families right around 2010. And so for me, I was exposed to this in my family. My parents owned rental properties. And so I just this is what I knew. And I was kind of comfortable, like used to go with my parents to pick up rent and things like that. And so just kind of knew about it. To me, it was a great strategy, but the challenge was like the cash flow was very limited. And that's one thing that I learned for me, in terms of our goals, was not quite cutting the mustard, but they were very successful ins and outs. And I'll talk about that in a second. And I'm also going to talk about how we acquired them, because I know a lot of people have questions about like, well, how did you get them? And how did you get a good deal? And So I'm just kind of going to go property by property and just talk about how I got it, how it happened. What you'll notice is there's no linear path, like it's all over the place, right? So the first two rental properties that I ever bought were both in Tomball and Cypress. And I bought them, as you can see, like the first one was Branchdale. I bought that for around $117,000. It needed about $15,000, $20,000 in rehab. And then I ultimately rented it out for a few years and sold it recently for like 190-ish. Oops, sorry. So around 190-ish. So did well, and I think we learned some lessons along the way. I acquired that. I had bought a Home Investors franchise. If you're not familiar with that is the We Buy Ugly Houses company. So I bought that thinking that would accelerate my real estate journey. What I ended up finding, and nothing against that company, is that I didn't really need them because I knew enough about real estate to kind of identify. However, what they do is they have people that are like distressed sellers that will call them and try and get an instant sale. So that's how I started acquiring a couple to start with. I only ended up buying two, and I quickly realized, wait, I can do all this stuff on my own. So I sold the franchise as well, and actually made a couple bucks on that by selling the franchise. However, that's how I bought the first two. But as you can see, that's what allowed me to get fairly low entry points in these properties, but both of them needed work. So like I needed to have the money to go in and buy, to rehab along the way. So I think both of them, I spent about $15,000 to $20,000 in renovation, and then put them in rental. And I did the BRRRR strategy on these. So I literally bought them, rehabbed them, and then refinance into a like a long-term rental property. I just got a message that I'm talking too fast, so I'm going to slow down. I apologize. I do that. So I did that and kind of retained those, and they were successful rentals. They stayed occupied for quite some time. Cash flow though was okay. It was like a couple $100 a month each, right? And so for me, I started kind of realizing that, wait, I'm not sure this is the strategy I want to go with. But it took me a while to learn that lesson. Then I bought so what I did when I bought these two, I immediately hired a property management company. That was great. And I had them kind of take over the day-to-day management, because I knew that at minimal, I wanted to grow a large portfolio of properties, right? So I did not want to like be bogged down with the day-to-day. So if for some of you guys that are more hands-on, you can certainly just kind of like learn the ropes a little bit if you want to, but I just knew it wasn't for me. And I felt like I had a bigger goal, so I didn't want to be distracted with that stuff. So I hired a property management, which also ate into the cash flow, right? Because typically you're paying anywhere from 7 to 10 to 12% of your monthly rent for the property management. And they kind of handle all the billing and all the repairs and things like that. But for me, I was like, okay, I'm just building a big portfolio. It doesn't matter. So then how I acquired this four house package. So this is kind of a cool story. So I reached out to the property management company and I said, hey, by chance, do you have any sellers that have a large portfolio that's looking to liquidate? And they said, actually, we do. We have a guy that has about 10 houses and he's starting to unload them. So what we did is we kind of they facilitated like a meet and greet. I saw some of his properties. They were all in the Cypress area. This is that kind of package right here. And we ultimately negotiated a package price. And what that allowed me to do was kind of get an average price point of each house a little bit less, which was nice. It was like 160, 170 each house, something like that. And so I was able to acquire them. But what was most appealing to me was he sold them to me with tenants in them. So as soon as literally I closed, and I'll talk to you about how I bought it and facilitated the financing for it. But I closed, and then literally a few weeks later, rent was received, right? So it's immediately had cash flow from the very beginning. So that was really appealing to me. How I acquired this though, financing a package like this is not necessarily easy. So what I did is I got a private money loan at the time from a high net worth individual that I knew that trusted me with a sizable amount of money. And so he looked at the deal, he analyzed it with me, and he said, okay, there's cash flow. These are fairly, well-conditioned properties. He gave me a, reasonable terms on it. It was, I want to say it was like 9.5%, 10%, which is not cheap, but I was not as worried because the cash flow was already in place to pay for that. And then once I acquired it, then it was just on me to refinance them. So I refinanced them one by one over time. And luckily the properties were in pretty good shape, so I didn't have to put in a lot of rehab into any of them. So I acquired those. I bought them for about $550. I think I held them for about 4 years, plus or minus. And then, our exit price for the whole package was about $750,000. So not a bad kind of entry and exit point. And then I'm going to talk about how my mindset has changed on some of this, but in general, it did fairly well. And then this one, 4006 Shoal Creek Boulevard, this was actually located in Austin. So some of you guys that are familiar with Austin, you might know Shoal Creek. So this is also an interesting story. So we had a client that was acquiring a property to live in Austin, and was gung-ho. It was a buddy of mine that had lived in Austin for many years and was gung-ho in getting this community, and he had to buy it. And so we helped him obviously finance it. And then when he closed, I stayed in touch with a realtor that was facilitating the deal. And I said, hey, if another one comes up, please let me know. Because my only kind of read on it was a close friend of mine that knows Austin like the back of his hand, was adamant he had to be in this property. So I felt like it was a good location. And lo and behold, long story short, it really was. So we ended up buying it around $250. I want to say this was like 2011, 2012. And we held it for 2 years. It stayed rented the whole time. And then we ended up selling it 2 years later for $350. So a very successful exit on it. However, this is one of my first L's. So I'm going to talk about a lot of L's that I've taken along the way. But had I just kept it, it's now comped at around $750. So like a buffoon, I should have just not sold this thing. But I also don't really beat myself too much up about like the future markets because there's so much uncertainty. If I feel like I had a good entry point and a good exit point and I'm comfortable with my profits, I'm never going to cry about it. But I'm starting to have a different approach on how I acquire in the thought process, and I'll talk about that in a second. So these were a good handful of our single families that we bought over the years. I just want to kind of show what those look like. Then the fix and flip world. So done quite a few of these. So for a while there, we started getting very active in fix and flipping. Obviously the positive is you kind of get this nice windfall of cash on sale, right? But the strategy and the rehab aspect of it is not for the faint of heart. And we took quite a few punches on all three of these properties that I'm going to go through. And it definitely ate into some of the potential profits. So when we had analyzed it, we thought there would be better exits. For me, if we profit, I'm not going to cry, right? Like if we made money, it's all good, right? And, for the most part, we've been fairly successful, but, some deals, the unforeseen will definitely gobble into profits. And so I'll talk about that. So 7611 Hammerley, which is this one here, we were really proud of this one. It ended up being like a mid-century house. We bought it extremely dilapidated. I think our entry point was around 140 on it. And we put in about 60,000 into it. And then we ended up selling it for about 265, 270. So like after commissions and everything, it was a $60,000 profit. It was great. It was a great property. We did really well. We had, as we had owned the single families, we got more and more comfortable with like the rehab, right? The levels of rehab. So this one ended up being completely down to the studs on the interior, all new drywall, all new flooring, all the way from kind of the studs out. And then we did the entire exterior, like all new roof, paint. You see the cedar siding and things like that. So this one was extensive. However, this was, I want to say about 5 years ago now. And so, all the costs of rehab and things were significantly more cost efficient. We had some struggles with our rehabber on this one. I'm going to talk about in some of the war stories that I'll share in a little bit. But ultimately it was a successful exit. I think this property, if we were going to sell it right now, is probably worth 400. So again, another lesson, maybe should have thought about a different exit strategy. Pasadena was in Mission Bend. Actually, both of these other two houses are in the Mission Bend area, kind of that A-leaf market. So we got exposed to it through this first one, which is Pasadena Road. I ended up buying this from a Facebook group. And so one thing, so a lot of people ask, or one of the questions was like, how do you source off-market properties? Well, I'll tell you right now, it's the Wild West, right? What you just unfortunately have to do is learn where deals are even, or transactions even happen. So social media is a great platform. There's Facebook groups galore for like trading real estate, but you kind of need to start, you need to move fast. And I'll talk about that in a second. One of my approaches in moving fast, but like, you also need to kind of have a sense of geography and locations and to be able to quickly deduce, hey, this is a place that I'm looking for, right? So whether it's a zip code or a neighborhood that you start to get familiar with, and you just kind of have a pulse or a radar out for it. And so like, unfortunately, I'm like habitually on these Facebook groups looking for stuff. And I'll talk about how that's really led to some great opportunities for us further down in the new assets that we've gotten into. But Pasadena, I found it. So it was like wholesaling. I think some people may or may not know what wholesaling is, but basically what somebody will do was they'll go out and market to homeowners that may have like distressed looking houses. So some clues are like really bad lawns, really bad exteriors, like rundown roofs and things like that, just properties that have not been maintained. So what wholesalers do is they'll come up with like a marketing campaign, whether it's door knocking or sending flyers or whatever, and they'll try and negotiate a contract with that person to buy the house. And usually it's at a substantial discount. Then what their job is to do is go and sell that contract to a real estate investor, like somebody like us or whoever, right? And then that person so they'll mark it up, sometimes 10,000, sometimes, 50,000, it just depending on how much room they've made. And then they'll try and sell it to somebody like us. And then we take on the project, and then they made some quick profit by selling the contract. They really didn't sell the real estate, they sold the contract. And so we've kind of backed away of working with wholesalers in a large degree, not for any reason. Like there's good wholesalers, there's bad wholesalers, there's people that do kind of some shady stuff to get these deals. And we just felt like it's not something we really wanted to be exposed to in the long term. And also our strategies completely changed. but I'll be honest with you, there are deals to be had if you know what you're looking for. So Pasadena, this property here, we ended up acquiring it, and then through a wholesaler. He ended up making like 15,000, and then there was like, as you can see, about $30,000 profit left on the bone for us after the rehab. But unfortunately, we thought there was going to be more. We ended up finding out we had foundation problems, so we had to spend like another $10,000 to $12,000 in foundation repairs to get the thing straightened out. The only reason we found that out was that our end buyer, when we had listed on the market, ended up trying to buy it with an FHA loan, and an FHA loan is a lot more stringent of loan product, and so that's where so they look at foundations, very closely. So long story short, that was what required us to go ahead and fix the foundation. So it elongated the contract and all that stuff, and our holding costs and things like that. By the way, all three of these were acquired with that same kind of hard money loan product. And so these type of properties, or like parcels of properties, are tougher to acquire with traditional financing. And I'll talk about some financial products kind of at the tail end of this. But like, these type of properties are really hard to get without getting kind of a hard money loan to get it. And there's a lot of costs as well as kind of holding costs associated with it. So keep that in mind. And I can talk in depth about these things as we go. And then Espinosa, same thing. This one was kind of funny. So we ended up buying it. We closed on it, if I remember correctly, it was New Year's Eve or the day before New Year's Eve. So it was like the last day of the year. This wholesaler just needed to dump it because they needed to close, and it's because the seller was going to back out on them if they didn't close on that day or by the end of the year. So we got a reasonably decent deal. But then before we could get into it and start rehabbing, there ended up being a hoarder in it. So that's like a whole nother issue and created a big mess, and we had to call the cops and all this fun stuff. So long story short, but we ended up doing half decent on it, but we were really quick in and out on this one because we gotten more efficient. So I think like 60 days in and out, and that's why the profit wasn't that big of a deal, because we got in really fast. So these were some of the flips that we've done. And I'm happy to talk about it. I'm seeing some questions starting to pop through, so I'll start kind of answering those as we go. So we kind of were doing this residential thing for a long time. And then we kind of realized that, hey, I think we're comfortable enough to start looking at commercial, right? So this is a handful of the commercial stuff that we've done. I'm gonna kind of just show you some pictures of them as I talk through the properties and like some of the strategies we had with them. But we started getting more and more confident and more comfortable, and thinking the transition from residential to commercial would be, a little bit of a cakewalk. Well, lots of surprises along the way. And so this is another reason I kind of wanted to do this, is like, I want people to just kind of know what they're signing up for if they're going to start diving into these products or these kind of asset classes. So I think a lot of people, at least on my social media, are familiar with the co-working space we had built called Start Houston. So that was the first kind of exposure to commercial that we had. It was this co-working space in East Downtown. The play was to build this co-working space and kind of like get in the tech incubator world and all that stuff. But we hedged that bet by buying the real estate. So we did, real estate, a large subset of real estate is all about timing. So we ended up buying this around 2011, 2012. And it was right when the Dynamo Stadium had been completed and East Downtown had started kind of really booming. So this was actually presented to us as a house. It was a realtor that sourced it for us. It was a phone call to an agent that we, was in our network. We called them and said, hey, we're looking to kind of build this co-working thing. And he said, okay, I'll keep an eye out. And literally a couple of weeks later, he said, you're not gonna believe it, but I found something that's kind of interesting. And so I had not really even been exposed to East Downtown at the time. And we just said, all right, let's just kind of check it out. As soon as we walked in, we fell in love with it. It was like an architect that had built it and repurposed a warehouse to live in. Long story short, so we ended up buying it. We paid, I want to say $365,000 for it at the time, which, if anybody that knows Edo, was a freaking steal at the time. But we did really well. We didn't put a lot of money into it because it had already kind of been finished well, and we kind of converted to the co-working space. We ran the co-working space for close to 5 to 6 years. Very, exciting and successful venture. But I learned through that journey that I really don't want to be exposed to operational businesses anymore. So the co-working business was not something that I wanted to be a part of, because it was like effectively glorified property management. which, as you remember, in my single family, I work so hard to not do. So I realized that I just didn't want to be exposed to operational businesses, and I just wanted to really be a landlord. So my partner and I on this one, I bought it with a partner. We used traditional bank financing to buy this. We had to go with a commercial loan, which is a different beast. And I'll talk about that as we go. I see some more questions about financing coming through, so I'll continue it. And please keep asking your questions. We bought it with a traditional loan. We put, I think it was 20% down. And then we acquired it and started operating. The first year of it was really not great from a co-working standpoint or from a rental income standpoint, because our market didn't even know what co-working is. But then after the first year, it like blew like wildfire, and we were 100% occupied by month 15, if I'm not mistaken. And then it just kind of rolled from there. From a cash flow standpoint, it did really well. I think, at our top end, we were doing about 12 to 15,000 a month out of the property. And if you think about for a property that we acquired for like 300 something thousand, that was insane. So we rode that train for a while, but again, the operational kind of requirements kind of started wearing on us. It took a lot of our time, and we also were running other, like our mortgage company, simultaneously. So it was just a lot to take on. But I love this property. We ended up selling it right around 2018, if I'm not mistaken. And we ended up, or 17, and we ended up selling it for around 625,000 or something like that. So a great successful exit. But again, one thing that I learned, I should have just kept it, right? We should have figured out another exit strategy and kept it, because it retraded again, meaning it resold again just recently for 900,000. So the real estate just continued to grow. So while we had bought this property, we got like the classic eyes are bigger than our stomach. So we had bought the 1121 Delano, the co-working space, and we were growing and we were busting at the seams, and we were like, let's do it again. Let's build something bigger. So this property was right down the street. It's called 2720 Leland. The property's still there today in East Downtown if you're in that area. So we acquired this as a shell, thinking that we were going to rehab this thing. And this is what probably my biggest loss across the board, because we thought that new construction renovation would be just as simple as like a regular rehab. Completely wrong, and completely did not know what the hell we were signing up for. We did really well on the acquisition of the property. This is when we started leveling up. And so we bought this property for $1 million. But it was, a 24,000 square foot building in East Downtown with basically an acre, or about like a full acre of real estate in terms of parking and things like that. So it was a fantastic property and a ton of potential, but we had no clue what we were doing in terms of or what we just signed up for in terms of rehab. So we vetted a bunch of contractors, and, the bids were all over the map. And so we had to literally do everything. There was nothing except for this shell, what you see here. And another thing that kind of created a little bit more challenge is we ended up trying to get what's called a historical designation. So this building was the original Schlumberger building from like 1918. And so Schlumberger, the oil and gas company. So what you can get is a massive tax benefit if you bring it back to its old glory and make it look like it was the old building. So you get like if I'm not mistaken, it's like a 10-year property tax deferment and things like that. So a lot of value in that. However, that created an extra layer of complexity to our rehab. We had to, for example, get a consultant that was very expensive to consult and confirm what the historical look was. And then we had to do research. For example, the windows had to match the windows from 1918. So that was all custom, right? It was going to all be custom work. So we had to do all this homework on top of just the general rehab budget. So we ended up hiring a contractor for, I believe our budget was $1.8 million in rehab. So the building was $1 million. We were writing kind of a mortgage check for that. I want to say it was roughly $12,000 a month with no income associated with it between me and a partner. So it was weighing on us really fast. You can't sustain that for very long. But we thought, we were making our money from the other property, and we were kind of pouring it into this one. So we're like, okay, let's see what happens. So we hired a contractor, very vetted, came recommended, friends had kind of had experience with them. Well, it ended up being a complete disaster. So this property ended up never getting completed, and we ended up selling it for a loss. And I'll kind of talk about that in more depth, but it was a really, really tough experience. And so I'll explain kind of some more details of what happened along the way, but it boiled down to, still not vetting our contractor well enough, and we kind of got screwed. So I'll tell a little bit about that. Another property that was kind of cool was we ended up contracting a property that was an RV park in Pasadena. So this was in 2019, so a little bit more recent. And so as we were kind of looking at kind of more layers of real estate that had better cash flow, this property fell in our lap. And it actually fell in our lap through another single family that we had bought. It was the same seller that ended up owning it. So sorry, I'm going to backtrack for a second. So we bought a single family property through a wholesaler, and then ended up getting to know the owner of that property. And he was just like ready to move on. So he didn't care that it was a wholesaler. It was a very transparent thing. But we ended up being the end buyer. And so we acquired it, but we actually still own that single family today in our portfolio. But he had mentioned that he owned an RV park. And so what I told the guy was like, hey, if you're ever ready to sell the RV park, please let me know. And he said, yeah, I'll let you know. Well, he kind of went dark, but we ended up staying in touch with him proactively, which is a strategy that you kind of have to do in real estate if you're looking for quote unquote off-market deals, is you have to understand and get to know who the seller is, and then just continue to keep in touch, right? And we had we didn't have a obnoxious approach. It was just a subtle, hey, checking in, how's it going, blah blah blah. Well, sure enough, literally a year later from the time we had bought the single family from him, he said, hey, I'm finally ready to sell the RV park. So we ended up negotiating a deal and learned really quickly about the RV business, right? I had no clue. This was one of those, like I mentioned earlier, very operationally intensive business, and even more so than kind of like a apartment complex or a mobile home park, because these are nightly turnovers or weekly turnovers, like people are coming and going. And so this property, I think we had contracted it for just at $1 million. And then, but it was doing $110,000 in income a year. So there's a lot of financial or jargon and like cap rates and things like that, like words that people use in real estate. And I'm happy to break those down. But at a high level, you're getting nearly 10 to 11% return on the, based on the cash flow for the price you paid. So it was a very strong real estate asset from that perspective. And so we ended up working with the bank and getting everything approved. They loved the deal and it was fantastic. And then a week before we closed, I kid you not, somebody else contacted us that owned RV parks, and they heard, and they found my number out of the blue. I have no clue. It was just a phone call. And they said, hey, would you mind if we bought it from you? And I was like, dude, we're closing, everything's done. And he was like, so we just kind of did the dance. And, a little short-sighted on my part, but he said, look, I'll give you a substantial markup. And I want to say it was like $150,000 to sell the property to him. And so at one point, the eyes just lit up and we said, screw it, we'll sell it. So we ended up not closing on this. We actually sold this. However, as the theme, in hindsight, should have kept it, because the RV market, when COVID hit, went absolutely berserk. And so we we probably would have made way more had we just kept it in terms of cash flow and growth and just kind of the top line upside. But it was a win in the sense that we made some money on it, but in the long run, we should have kept it. And so you're probably going to sense the direction my new strategy is going, but I'll keep talking about it. So when we actually, back to kind of the co-working space, when I sold that, we ended up having a broker help assist us in selling that. So when I sold it and we did fairly well from a profit standpoint, I wanted to immediately re-roll that money into more real estate, at least for myself, right? My partners moved on back into the tech world. I stayed in the real estate game, and I said, hey, look, I need, we've got this windfall of cash. Can we park in another asset? And I had actually been exposed to Rosenberg through my uncle, who had some active real estate there. And he said, hey, Rosenberg's an interesting market, keep an eye on it. So I told that to the broker that we were working with. And I said, hey, if you see anything in Rosenberg, let me know. Well, just pure luck, he said, hey, I actually have a listing that I just got in Rosenberg that could be interesting for you. And I said, okay, tell me more about it. Well, it was this freestanding building on a street called Avenue H, which is kind of like the Highway 6 of Rosenberg. So it's a prime street, and it was kind of growing. And so I like Rosenberg because of the overflow of Sugarland kind of bleeding out. Real estate's really hard to get into Sugarland, so people are kind of moving into Richmond Rosenberg. And this was now going on 4 years ago when we kind of transacted into this. But what happened was, so he said, hey, this is an interesting deal. Payless just went bankrupt as a company. So the landlord kind of inherited the property back. The tenant just vacated and they've left it exactly like Payless. So we acquired this, I want to say it was $335,000. And we bought it, and it was, you know, like completely well kept because it was a national tenant, Payless, that was keeping track of it. So we really didn't have to worry about too much maintenance. But we bought it and we were like, okay, we'll figure out what we're going to do with this thing. So the plan when we bought it was we were going to go ahead and rent it out, right? So as just kind of like a retail storefront. So we put it on the market. And we started getting some heavy interest from kind of standalone real estate company, retail tenants like Amco Insurance and those kind of like insurance companies. So we had a few of those guys start calling us, and we ended up ultimately getting 3 of the same type of company get into a bidding war about renting it. So we did really well from a like strategy standpoint, but there was a curveball. So what ended up happening is 3 of them were kept kind of going back and forth saying, hey, I'd like to rent it for this. I'd like to rent it for this. And we started we picked one, which was a more prominent one. We said, all right, we're going forward with this guy. And we started negotiating the lease and things like that. Well, while that happened, one of the other ones came back and said, hey, would you actually sell this to me instead? And I was like, no, we just bought it. Like, there's no way. But you know, I told the broker, I said, look, the only way I'll consider selling this is if he'll pay me like the full value of what it would be after I'd rented it today versus me having to deal with renting it. And keep in mind, we'd actually not done anything to this property. We'd not cleaned it, not broomed it, not touched it. It's just been sitting in its state. So the guy, the broker took our kind of counter to the offer, and he said, look, they want like 600 grand for this thing, which is kind of roughly what it would have been worth once it was leased. And the guy was like, dude, I can't get there, but I'll get to like 550. And we just bought it for like 330,000. And it was not even a year yet. It was like a few months into it. And he said he'll sell it to us for 550. Or buy it from us for 550. So I said, okay, that's a number we can't ignore. So we ended up contracting that. We actually had to delay the closing for our sake because we would have got hit with short-term capital gains. So we waited a full year before we let them close, but the guy just wrote it out. Now, again, in hindsight, probably should have kept it, but it was too much money to ignore, right? And I hope I don't sound like I'm talking about money, but this is just the real estate business, right? So I hope I don't sound like arrogant. I'm just kind of sharing our journey. So far, a lot of wins. I promise there's a lot of L's coming, but you know, that's kind of the nature of this thing. There's a lot of ups and downs, but each time we were kind of getting more exposed to different asset classes and kind of different strategies and learning about like negotiating long-term leases and commercial leases and each of those things. So I ended up selling this and using that money into another property. So the next one here. So this one is 3634 Glen Lakes. So this is now, it's been years since I took my punches on that vacant 2720 Leland building. So I'm a lot more confident now about kind of commercial construction and rehab and development, things like that. And so I saw this property, you're not gonna believe it, but this was a 40,000 square foot office building sitting on 2 acres that I found on a Facebook group. And so I told you guys, I wanted to mention my strategy about like these Facebook groups. So the one thing that I've learned is if I see a post that I like, I immediately direct message the person and try and get a conversation, try and get their phone number, get on a phone call, and then I'm trying to meet them that day. The reason why is if it's a hot property, then there's like, I call them vultures, there's real estate vultures. So like everybody's going to start trying to chase them and they'll start getting a lot of attention, but they realize that somebody that's willing to meet you today or the same day is a little bit more serious. So the guy that had posted this property for sale, I remember the post clearly. He said, hey, I have a office building near Sugarland for sale that I want to get rid of. And I was like, office building near Sugarland that's like, and he said it's like dilapidated. And I was like, that's weird because most of Sugarland real estate is new. So I was like, that's really strange that'd be like a dated property. So I was like really curious. Anyway, so I went ahead and drove out that day and met with the guy. And so the story of this property is it ended up being two brothers that had inherited the property from their dad who had built this property in the 80s. Well, the dad unfortunately had passed away many years ago. And then the property got held in what's called probate, which is where the family and like, like people inheriting it are fighting about who's going to take over the property. So what ended up happening is the sons ended up winning the inheritance after almost a decade, but nobody was taking care of the property the whole time because they didn't have the money or the wherewithal. So it sat vacant. So if you can see in here, like literally a tree grew inside of it. And it was just like left alone. It was a complete mess, right? So when I walked it, I was like, oh my God, here we go again with this big, huge project, but let's see what we can do. So we ended up kind of talking and I told him like, look, I'm serious. Let me get my group together. And, I've been very blessed over the years being in real estate to have people and partners that kind of see the opportunity. And if I bring them an opportunity, can bring some of the capital. By no means am I like a super rich person or anything. We just, I just take a lot of swings at bat and sometimes they work. So we ended up acquiring this property for $1.5 million in its state, in the current state it was. So this one, we started rehabbing right at the tail end of 2019 and just finished completion right at the end of 2021. COVID kind of wrecked our world from the rehab standpoint, so it took a lot longer, but thankfully we were in construction through the heat of quarantine and things like that. And this property is now fully online and we're approaching right at around 50% occupancy on it. So it's still a long way to go, but I feel really good about kind of our cost into it. In terms of numbers, we are a little over $3.5 million in rehab and into it. So it's right around $4.5 million, $5 million kind of all in. But we think once it's stabilized, it'll probably be like a $7 and $8 million building. So, it's a long tail project, but it'll work. By the way, I acquired this through a joint venture. So I had a partner with it. I put in probably peanuts compared to like the total deal size. But because it was my deal, I kind of was able to control it. I was the one that kind of structured the whole thing. And I had an amazing capital partner that had experience in construction and development and real estate that came in and facilitated a lot of the capital. So just being totally honest, right? But I'm excited. I'm lucky to be kind of a decent, a reasonable stakeholder in the building. So my equity was a lot of sweat and a little bit of capital in this deal, but it's a great project. So let me move on to the next one. So then this one is Victory Storage. So we bought this a little less than a year ago. So this is my most exciting deal to date, and I'll talk about why. But like, so I found this on a lot of you guys probably know the commercial real estate listing portals. One's called LoopNet, right? So it had been sitting on LoopNet for almost a year. But if anybody knows self-storage is a very hot asset class. And so a lot of people are looking for it. And so for me, it was really weird because it had been sitting on the market for a year for like an asset class that typically moves really fast. Like if you look right now, a self-storage property will sell in a heartbeat when it goes online. So I was like really worried and like curious why, right? So I started reaching out, and one of the first problems is I'd leave messages and nobody would call me back. And so I kept calling. The persistence was there because I just needed to know what's going on with this deal. So finally, one guy, like there was a day where I just called the guy like 5 times in a row, and finally somebody picked up, and it ended up being like a random realtor that just ended up listing it for a friend and really had no motivation to be responsive, which was a horrible situation. So I same thing. I said, hey, can I just go out and see it? So he put me in touch with the seller, and we went and drove out. I drove out the next day, looked at it, and it ended up being a guy that was living behind it in a house, had been running the storage facility, and was ready to sell. They were ready to retire. It was their family business and they were ready to retire. So I looked at the property and the project, and it was mispriced on LoopNet as well. It was priced like really odd. And I'll talk about kind of like the numbers to look for when you're kind of analyzing commercial properties. But in general, it didn't make sense. It was overpriced. And so I think that's another reason it sat. But so when I talked to him, I was like, hey, dude, like, I don't understand why you're asking. He was asking $1.3 million for a storage facility that probably should have been worth like 800, right? And he was like, oh, no. It's the storage facility, it's the house, and 2 lots that I own all together. But when it was listed as just the storage facility. So that was the first problem. So one clue for you guys to find deals is look for mismarketed properties on listings, right? So there's a bazillion clues that you can look into and find, but like you got to kind of know what you're looking at first and foremost, but like that was the clue. I was like, wait, this is why it's been sitting for so long. He's trying to sell the whole package, but he's priced it or listed only as one asset. So when I ran the numbers on the package, his numbers were a little bit still egregious. And we ended up negotiating it down to like $915,000 for the whole parcel, including the house. And he agreed, and we ended up acquiring it. This property now generates $140,000 a year in revenue between the storage facility, and we ended up remodeling and renting out the house as well. And then we're about to expand the 2 lots that were included. We're going to build on one of them, and we're adding additional storage for vehicles on the other one. So it's gonna get close to almost $200,000 in rental income once it's all said and done. So keep in mind, we paid $900,000 for it. So, and if you look at it, I mean, aesthetically, it's just like you would drive past these things on the highway and not take a look, but it ended up being a cash cow, right? And so this kind of leads into kind of the direction that we're kind of starting to focus on in terms of an asset class. So let me tell a few war stories. Real quick, I'm going to break and just kind of check on questions. Let me just make sure a Q&A didn't. Okay, so there's a couple questions here about financing. So hard money loans, are they secured or unsecured? They are first lien position on the property that you're buying, almost always. So the difference between hard money and private money, it's kind of blurry. Hard money is usually like a company. For example, our company offers those now, and we work with a lot of fix and flip investors for that. So they're more like structured in terms of what they're looking for, and they have a narrow box of kind of real estate parameter or like lending parameters. A private money lender is like effectively like a friend, right? And says, hey, I'm going to lend on you. Usually they still are savvy enough to like secure it with the first lien on it, but their terms might be a little bit more flexible, but it's really the relationship that they're lending on top of the asset, right? But that's really, at least my definition of the difference. Let me see if there's any other questions, but feel free to throw in any of the questions you guys have. Okay, so let me keep going. So let me talk about some of my war stories. So, and I know we're running up on an hour, so I'm going to end in like 10 minutes, I promise, and then just open it up to all Q&A, as well as audio if you want to jump in and talk. But okay, so some of the war stories. So when we were flipping our Hamley project, which was that mid-century modern one with the cedar front, there was so everybody knows what HOA is. Not everybody may not know what a civic association is. So an HOA is in your neighborhood. They're like the kind of neighborhood police, make sure that yards are mowed and et cetera. And there's like a committee and a board, and everybody kind of, you pay a fee, and then they do certain improvements to the neighborhood. Where a civic association is effectively a less formal version of that, where you're not required. It's more of like a voluntary thing. And so when we bought that property, it was part of a civic association, but we didn't know. And so what ended up happening was this is in Spring Branch, the property, which is now a very hot and up and coming area. What we didn't know is the civic association was actually pretty active. And they were starch defenders about like people kind of updating the houses, even though like this house was a complete eyesore. So long story short, it was nothing against old people, but it was a couple of grumpy old folks that were running the civic association. And they were not happy that we were renovating that property. And they decided that they wanted to call the city of Houston on our contractor every single day to try and look for like non-permits. Well, unfortunately for us, which is the very next point, our contractor was not getting permits on a few things we found out along the way, and it was slowing up our rehab. So we'd have to stop, he'd have to go and get it. They'd keep sending an inspector out and they'd keep chasing us down, and they got more and more aggressive. And so long story short, what really was the tip of the iceberg for them was there was a rule when you look at the property line of building a fence in front. And the city of Houston has a rule, but then the Civic Association had another rule that said you couldn't put a fence in front. But if you're on Hammerly Boulevard, it's kind of a dangerous street because there's a lot of fast cars. So we're like, okay, this property will be more attractive if we put a fence in front of it. And so, and we per the rules that we saw with the city of Houston, there was nothing that stopped us. But the Civic Association said, no, we're not gonna allow it. Well, we went ahead and did it. And because the Civic Association was a voluntary thing, and all hell broke loose. They literally were, they came to our open houses with like flyers saying we were in violation of all these rules and all this crazy stuff, right? So we ended up having to hire an attorney to look into the homework, and we ended up finding out that they were so informal that they had actually lost, they were supposed to renew their like rules of like as an organization every couple of years. Well, somewhere along the way they didn't. And so they were actually not even a real association anymore. And so we were not worried at that point, right? We knew we were going to be right. Well, they kept like kind of harassing people. They were like scaring away buyers. It was like super frustrating. And finally we found a buyer that like knew to ignore them and like not, but we ended up having to call the cops on a freaking granny and tell her to get off her property because she was like harassing people. It was so bad. Anyway, so long story short, we ended up like learning along the way. The side story is we had a contractor in there that was like starting to slip, and we had to like fire him, start the project over like in the middle of it with another contractor who had to pick up the pieces. So we like went way long on this thing. I think I told you guys we made about 60,000 on that flip. We should have been like an $80,000 profit on that thing, but it ended up dragging out because of all these kind of pain points, unfortunately. But anyways, it ended up eventually selling, and we ended up moving on. I talked about the foundation repair on that other one. That was kind of a surprise. That same property had a huge problem with the title company. So the 30-second story of it is we ended up buying it from that wholesaler I told you. Well, it was a distressed seller in front of it that was about to get foreclosed on. So they looked to the wholesaler to be their saving grace and sell it quickly, right? That's why they sold it at a discount. Well, we were coming in behind that wholesaler to buy it, right? Well, not only were they behind on their mortgage, turns out they were behind on their HOA dues as well. So the first person that can foreclose on you is your mortgage company, but right behind it, an HOA, depending on how it's structured, can actually foreclose on you as well. So when we closed, we beat the deadlines for the foreclosures, and we made all the payments and made sure everything was done. It was paid out of the proceeds of our purchase price on behalf of the seller. Well, the bank got paid, but the title company was too late to pay off the HOA foreclosure. So what we didn't realize, it actually went to auction and got foreclosed after we had bought it. And we had no clue because we were just moseying along, doing our improvements, doing everything. It wasn't until when we were actually relisted the property and were selling it, that when the title company pulled up the contract for our sale, they said, hey, your entity name that you bought this in does not match the property ownership. And I was like, what are you talking about? And they were like, yeah, look, it's under another name. So lo and behold, somebody had bought the lien of our, like of that HOA and took over the property. And so we had no clue. And so it became a complete cluster. How we settled it is the title company had to step in, correct it. They had to buy the property like lien off, and it was literally off their like write a check. And I think the title company ended up losing like $20,000 to buy that lien back and then correct it in order for us to close. So it was a total mess, right? But it was crazy. It was scary. Like we had no clue. Had a hard money loan on it. I was terrified. I was like, oh my God, like, you know, what's going to happen and all this stuff. But you know, as you start to kind of do more and more, you get less and less scared because you just realize there's mechanics to do it. You know, it took some relationships that I had to help learn how to navigate it in the real estate world. So I was calling my real estate attorney friends and real estate title companies, like, how do you navigate this? What happens? Da, 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 da. And lo and behold, it ended up being okay, but it was like super scary at the time. One of our other properties, I think I mentioned the squatters that showed up. We had to call the cops. They demolished the place, even worse than the rehab that we had thought. So that was a super mess. The Leland property I had mentioned, that was that big one. So what ended up happening with that one is we had a, what was it, $1.7 million rehab budget. And how it works when you're doing a substantial rehab like that is the bank will deploy money in small chunks. So they'll say, okay, you did $200,000 worth of work. We're going to reimburse send us the receipts, the invoices, and we're going to reimburse the contractor accordingly. Well, what was happening is we started noticing the contractor was like having less and less action on the property. And one thing that I learned the hard way is if you're going to do any level of rehab or construction, the principals, like the people that are leading the deal, you got to be there every day. Like, you just got to go check on it. And so like, that's one thing I do is I'll go check on our projects on the regular, or at least one of the partners will, to make sure there's action and make sure things are happening. Well, what was happening is we started noticing that this contractor was not there every day. And we just like write a check for like $50,000 worth of like electrical, and there's like one dude putting in wall sockets, like, and I was like, this doesn't make any sense. So we started kind of really paying attention. Well, unfortunately for us, the contractor had supplied some invoice, like puffed up invoices, and sent it to our bank, and our bank approved and went ahead and paid the dude, and then he ghosted us. And so that deal ended up losing almost $500,000, unfortunately, for myself and the partnerships, right? And it was really, really painful. And we learned a lot of lessons. So I chalked that up to a very expensive education or MBA in construction. But basically, these are things that, had we just been watching. And so the reason that happened is he got us in the middle of the holidays. So myself nor my partner were checking it all the time in that window of time. So everybody was kind of off in their holiday mode. So we had almost a 1 month stretch where nobody was checking it. And so that's when he kind of snuck in those invoices and then ghosted us and disappeared. So we ended up having to like start all over, complete disaster, never finished the project, sold it at a loss, and just got out, cut our losses, and moved on. But so that was a unfortunately pretty painful one. So for me, how I prevent that from now on, we're there every day. Like, what's going on? What's happening? We're obnoxious. We're like in their face, in their ears, like what's happening. And there's a sniff test. Another thing that I always do now is like whatever project we're doing, whether it's like a plumbing job or a roof job, sounds corny, but I'll literally watch YouTube videos like the night before I meet the contractor and just watch what other contractors say is supposed to be done. So at least I'm intelligent when I show up, right? And I have a sense of like what's going on. And so, I mean, that's helped. And I learned a lot that way too. The Delano property, which was our co-working space, we had the AC copper stolen, had to completely wreck and replace the AC units when that happens. That was a huge, painful one. Thankfully on that one, we had insurance and insurance covered that, but just that whole process is really stressful. And then Glen Lakes, the big Sugarland property, while we were waiting for our permits to be approved, which is a very long process, we had multiple layers of vandals hit that thing. The property has beautiful skylights that are on the ceiling. We had some kids come in with bricks and just bust out all the skylights. Ended up being $100,000, hickey to the deal, which was super unfortunate, but that's just part of it. So when you start to level up in these bigger things, you need to have partnerships and like a structure or the capital to keep like it, keep the capacity for these kind of things to happen, because they happen. So anyway, so those are some of the war stories. Feel free to ask questions along the way on any of that stuff. And then I'm going to kind of round out, and then I'm going to open it up. So where am I at now these days, right? So I've now focused and kind of honed in on more qualitative assets, right? A lot less of the kind of like fix and flippy stuff in neighborhoods that I probably want to hold a property. So I think about it like, hey, would I want to own this property for 30 years or 40 years, right? And that's what I look at now. And would I be proud to own it? Would I want to show my kids, or whatever the case may be, if we still held it in our books. So that's kind of the eyeballs that I have when I look at it. And our mission now is to never sell. So our goal is to acquire properties and build them to cash flow to where you can refinance it and get most of your money back out that you invested into it in a reasonable amount of time, and then just let the tenancy pay down the property for you on the new loan, right? And then whatever proceeds you have, if there's profit or value that you created that you can pull out, use that to continue to acquire more. So we've started deploying this strategy, and it's so far it's working. So what we'll do is we'll just pull money out on an asset that we created value on, and then continue to buy and buy more, right? If you absolutely do want to sell, there's a strategy called 1031 exchanging, where you can avoid the tax implications of the sale and roll those gains into another property. I'm not a tax expert, happy to kind of bring one on in a future one of these calls to have a discussion around, but that's a strategy that people use, real estate investors use, to continue to level up. And you can do that forever. Like, you can just keep going. Now there's rules, and every time there's like administration changes, like the rules around it change, but for now you can continue to do that. So for us, I finally found kind of our like asset class that we like, which is self-storage. And so our mission now is to continue to buy and build until we get to about 100 million in asset value, right? So, our first one is now worth around $2 million. We're about to close on another one that's another $3 million. So I'm chipping away. I've got a long way to go, as you can see. But as we've built the systems and the operational acumen of running a self-storage facility, we really like that asset class. It is very crowded and there's a lot of competition. So it's a lot harder to acquire them, but we're swinging shots every day. We're trying to make offers on self-storage like literally every week. And so you just got to keep, swinging, and you'll start to hit them. And so we're continuing to buy more. The 100 million strategy is to try and build that with a limited partnership. So, we want to continue to level up and just kind of refinance into bigger or more self-storage without having to take on a lot of partners. That way, all of us can get a large subset or like a large stake of ownership in that portfolio. So like, we narrowed our mission, and that's what we do. And we've just gotten really good at that asset. Having owned our first one, we think we've got a good playbook to follow on. And then secondarily, we're in the mortgage business. So we have a note fund that we are bringing in investors to that want to earn cash flow, but that's it. So like literally all the single family we've unloaded or are continuing to unload. Anything else like the office buildings, all that stuff, they're now kind of not an objective that we're focusing on. We're just, whatever we own, and we're not acquiring anymore. We've narrowed our focus, and that's our game plan now. So, it took me a decade to get to that point. And what I was kind of mentioning to you guys at the beginning of this presentation is like, I think all of you guys should think about like, what is the end game by researching the asset classes and finding one that you like, right? Or are attracted to, and then like decide, hey, I want to get to 50 houses or 100 houses or 20 Airbnbs or whatever it is, or launch a fund or whatever the case may be. And then like work backwards, right? Like if I had done that years ago, I would probably be a little bit further along in our real estate journey, or at least have focused a lot more, or at least paid attention to the asset classes that I wanted to be a part of way earlier before they got super hot. So how can we help? We're, and again, there's nothing to sell here, but just if you have questions, Matador Lending, we do financial tools for all the real estate buying. That's what we do. We have a real estate team that can kind of focus on real estate investing. We've helped quite a few friends acquire some real estate. That's what I mentioned in my Facebook post. We are slowly going to have these self-storage facilities that if people want to invest with us, we welcome friends and family, and we're trying to stay in that kind of like perspective if we can, to keep it as tight as possible. And then just ask anything. Like you guys are my friends, and I'm blessed to have so many of you in my world, and so I'm here to help, right? So that's all I've got in terms of the presentation. I hope kind of painted some pictures and gave it. I'm going to focus on the chat. Let's just use the chat if that's okay, so that it doesn't get too crazy and noisy, but feel free to ask questions. Cash out refinance and home equity line of credit. Yeah, so I'll give you 30 seconds. So once you've acquired a property and you've got a sizable amount of equity, you can typically cash out refinance up to 80% of the new value. So you have to have a sizable increase in value to tap that equity, depending on what you ended up putting down, right? And then you can take money out, right? Up to 80%. That's the, at least in Texas, that's the limit. You can, home equity line of credit, also same rules apply. You can get up to 80%, but the home equity line of credit is a second lien. So you would have your primary mortgage in the first, and then whatever room you have up to 80%, you would have the ability to get a home equity line of credit. A cash out refinance though is one lump sum check given to you based on whatever room you have, and you just spend that and it's just pulling your mortgage. The home equity line of credit is like a credit card. Literally, you can pull up and on and off on it. You'll like take out 10,000, pay off 10,000, and so on. So, and the interest and the payments are based on what your balance is, just like a credit card. Next question: open up investments for self-storage deals. So yeah, we're actively about to. We just got under contract on a new one, and we should be doing a offering for that for only our friends and family, because it's not a huge one. So I'll happily circulate. Everybody's got my email, obviously, because I emailed everybody. Feel free to send a note to me if you're interested in that, or interested in being an investment partner with us. Again, I'm not asking anybody to. I'm just saying, if you're interested, just shoot me a note, and I'll make sure that you're involved when we have that available. Dirt. Okay, so I apologize, Mike. A great question. So I actually, along the way, have bought 30 lots all around Texas. So we have a bunch of land. So, but it is not impressive land. It sounds better than it really is. So we have a bunch of random lots. My formula was very rural, and my goal was to get under 10 cents a foot is what I was trying to acquire for. And so I bought a bunch of random lots all around Texas that kind of fit that mold. It's like half acre. And my only formula was it's got to be under 10 cents a foot, and it's got to be near water. So I have near Lake Conroe, Lake Livingston, some random lots. I've just now started to look at how to monetize those. So there's like some kind of funky Airbnb plays where like people actually rent land for like glamping or camping, right? And they'll like just rent raw land. We also have started kind of selling those on an owner finance where we'll just be the bank for people. So we have some dirt, but true development, we have that lot next to the storage facility where we're going to be building a ground up extension of our first storage facility. So that'll be a true play there. Any other questions? I see some more coming in. I think I'm going to give it like 2 more minutes. Otherwise I'll round this thing out. I know we're running long. Awesome, guys. If no other questions, y'all all know how to get in touch with me. I'm going to be doing this every month, and I'm going to start bringing in, like I mentioned, people that I respect in the real estate industry in different classes. I think my next one, I'm going to talk a lot more. I'm bringing in a guy that does Airbnbs at like the next level, because I know that's really hot and a lot of people want to get into it. I personally don't, because I think it's way too much operational, but I know a lot of people do. So I think that'll be an exciting one. If you guys have anything that you want to learn about, feel free to ping me and ask questions, and I can bring on people. I know people in industrial real estate, multifamily, you name it. And I'll bring all those kind of close friends on to talk about their kind of strategies. Mine is like still, I feel like I'm still amateur hour in the grand scheme of things. So that's why I was like, hey, look, a lot of people just want to know where to start. And that's why I just wanted to share all the crazy stuff that we've been doing along the years. And again, now we've got a kind of focus strategy. Well, I appreciate you all. It's so glad seeing everybody. I want to stay in touch with everybody and do a better job of it. So can't wait to see you guys. All right, guys. Thank you. Bye-bye.